This is the third in a three-part series of resources on adjusting entries. Part 1 describes the reason we need adjusting entries. We then consider unrecorded transactions, both receivables and liabilities. Part 2 investigates prepaid expenses. Part 3 inspects unearned revenues. In the previous resource, we realized that circumstances change in the business world. Sometimes we miss things that have economic effects on our company, and we must make some adjusting entry at the end of the month. Our general process in creating these adjusting entries is rather straightforward. First, we need to identify the accounts affected. One account will always be a balance sheet account. This will get matched by changes to one or more income statement accounts. Then we need to perform appropriate calculations to find the dollar amount of the transaction. We look specifically at unrecorded liabilities and receivables, and also prepaid expenses. An additional situation that requires adjusting entries are unearned revenues. Unearned revenues are very similar to the prepaid expenses we considered in the previous resource. A customer pays in advance for some goods or services. The company must deliver the goods or perform the service. Therefore, the unearned revenue acts as a liability. It is also important to note that the revenue from the sales is not recognized until the goods are delivered or the work performed. Let's consider an example. 8 Banners Amusement Park will celebrate their 50th anniversary next year. They plan to sell limited edition commemorative plush toys in their gift shops. They place an order on April 1st for 100 of the plush toys from Polly's Plushies, paying the $5,000 cost in advance. The order is to be filled by May 20th, as 8 Banners wants to ensure the toys are in stock in plenty of time for the beginning of their season. Polly's Plushies actually fills the order and delivers on April 30th. How would Polly account for the initial transaction, and what adjusting entry is needed for April 30th? For the initial transaction, Polly's Plushies received $5,000 in cash. So one of the affected accounts will be the asset cash, which increased. Since assets increase with debits, the cash accounts gets debited $5,000. The matching account will be the unearned revenues. This liability also increases by $5,000. Since liabilities increase with credit, we will credit unearned revenues. Now let's see the actual journal entry. As with all journal entries, we start with the date of the transaction. We then list the account to be debited, cash, and the amount of that debit, $5,000. Next is the credited account, unearned revenues, with a matching amount of $5,000. We finish with an explanation of the transaction, describing that the payment of $5,000 was from 8 Banners Amusement Parks for the 100 plush toys, to be delivered by May 20th. But what happens when Polly delivers the plushes on April 30th? On that date, Polly removes the liability by actually fulfilling the obligation. Therefore, the liability decreases. This would be entered as a debit to the account. Because the transaction has been completed with the delivery of the goods, Polly can now recognize the revenue from the sale. Therefore, the sales revenue account will increase. Sales revenue is part of owner's equity and increases with credit amounts. Therefore, the $5,000 amount gets listed as a credit to sales revenue. And the actual journal entry? The date of the adjustment would be April 30th. The debited account in this adjustment is to unearned revenue and the amount of $5,000. This is matched by a credit to sales revenue. The adjusting entry closes with a description that the revenue was earned by delivering the order of 100 plush toys to 8 Banners amusement parks.